Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Sanmina.
If you find our talks useful, please consider subscribe, like, and comment underneath. You know, when most people picture the artificial intelligence revolution, they visualize lines of code.
Right, or large language models.
Exactly, sleek software interfaces, or maybe they picture a tiny, incredibly complex silicon chip. But software doesn't run on magic.
Definitely not.
It runs on heavy metal. I mean, it requires massive steel server racks, miles of copper wiring, industrial scale power routing, and, incredibly complex liquid cooling systems.
Oh, absolutely.
So today we are doing a deep dive into the blue-collar, heavy metal reality of the AI boom. Because historically, the company we're discussing was known for, well, traditional low-margin electronics manufacturing.
Yeah, just building basic circuit boards.
Right, the necessary but entirely unglamorous background work of the tech sector. But over the last few quarters, Sanmina has completely rewritten its own DNA.
They really have.
They are transforming into a physical infrastructure powerhouse for AI. And the market is having a really hard time figuring out how to price this new reality.
And that disconnect, the gap between what this company used to be and what it is right now, that is exactly where the opportunity lies for you.
Yeah.
We are basically watching a legacy electronics manufacturer move entirely up the value chain.
Mm-hmm.
They're stepping away from just soldering components onto a board, and they're moving directly into the business of engineering the physical architecture that makes generative AI possible in the first place.
So we are going to figure out how they manage this pivot, what the massive numbers from their second quarter fiscal 2026 earnings actually mean, and whether this stock is a short-term momentum trade or a foundational long-term wealth builder for your portfolio.
Let's start with those second quarter numbers.
Oh, yeah, because they completely shattered Wall Street's models. I mean, we saw revenue hit $4.01 billion for the quarter. Yeah, and to put that in perspective, the consensus estimate from analysts was hovering around $3.29 billion. So they didn't just edge out expectations, they blew past them with a 102% surge year over year.
And that top-line explosion, it flowed directly down to the profits.
Oh, absolutely.
Non-GAAP diluted earnings per share hit $3.16. Again, the street was only looking for 2.4s.
That's a massive beat.
It's a 125% jump in earnings per share year over year. That is the kind of hypergrowth you usually see in a software startup, right?
Right. Not a decades-old physical manufacturing company.
Exactly. But to understand why these numbers look so anomalous, we have to look at the engine driving them.
Right.
And the vast majority of this structural shift comes down to their recent acquisition of ZT Systems.
Yeah, that was huge.
In this quarter alone, the ZT Systems business contributed $1.88 billion in revenue.
Unbelievable.
And every single dollar of that was driven by AMD-based accelerated compute shipments.
Okay, wait, stop right there. Because accelerated compute is a phrase thrown around a lot in financial media right now.
It is.
So if I'm building a traditional data center versus an AI data center, what makes accelerated compute so fundamentally different from, like, a hardware perspective?
Well, so a traditional data center relies on standard central processing units, or CPUs.
Okay.
And they're great at handling a lot of different tasks sequentially, one after the other.
Right.
But training an artificial intelligence model requires processing millions of calculations simultaneously.
And that requires graphic processing units.
Exactly. GPUs, which are the absolute backbone of accelerated compute. And putting thousands of these GPUs together in a single server rack, it literally changes the laws of physics inside that data center.
You said the power draw.
Yeah, they draw an astronomical amount of electricity, and consequently, they generate an amount of heat that would literally melt a traditional server rack.
Wow. So the hyperscalers, the massive cloud providers like Microsoft or Google, they can't just buy a bunch of AI chips and slot them into their old server racks.
No, not at all.
They need entirely new physical infrastructure.
They need an entirely new ecosystem of power delivery and thermal management. And the demand for that infrastructure is currently at a fever pitch.
Yeah, it seems like it.
In this recent quarter, Sanmina saw massive customer pull-ins from the second half of the year.
Right, because hyperscalers are engaged in an absolute arms race.
Exactly. They are terrified of falling behind in AI compute capacity, so they are going to their infrastructure partners and just demanding that future orders be delivered and integrated immediately.
You know, it makes me think of an automaker that has spent 40 years building perfectly reliable, everyday commuter cars.
Okay, I like that.
It's a solid business, but the profit margins are razor thin because you're competing on scale and basic efficiency.
Right.
Then management goes out and acquires a world-class Formula One engineering team. Suddenly, this commuter car company is building hypercars and winning international races. Like, that Formula One DNA fundamentally changes what the company is capable of building, and more importantly, who wants to buy it.
That's a great way to look at it.
And that seems to be exactly what ZT Systems is to Sanmina.
The Formula One comparison is highly accurate, especially when we talk about profit margins.
Right, because traditional electronics manufacturing services, the EMS sector, is a notoriously low-margin game.
Very low margin.
Yeah.
You're generally assembling parts that someone else designed, just racing to the bottom on price.
Yeah.
But when you start providing the large-scale system integration required for accelerated compute, you aren't just an assembly line anymore.
No, you're solving the hardest physical engineering problems on the planet.
Exactly. And solving those problems requires specialized, highly engineered hardware. You mentioned the heat earlier.
Yeah.
I imagine air conditioning doesn't cut it when you have thousands of GPUs running simultaneously.
Standard forced air cooling is completely obsolete in these new environments. Sanmina is engineering and manufacturing complex liquid cooling solutions.
Right.
They're building manifolds that pipe chilled liquid directly over the processors to pull the heat away.
It's incredible tech.
It is. They are designing custom subassemblies and advanced power management systems just to handle the sheer voltage these racks require, without tripping systems offline.
And because they are delivering fully integrated mission-critical systems rather than just loose parts, their pricing power fundamentally changes.
Which perfectly explains the margin expansion we're seeing in the earnings report.
Yeah.
I mean, their non-GAAP operating margins hit 6.4% this quarter.
Which is huge for them.
Right. That might not sound massive compared to a software company, but in the world of physical manufacturing, pushing margins up 80 basis points year over year and sustaining them above 6% for 3 consecutive quarters is a major structural shift. But taking on this kind of hypergrowth, expanding into liquid cooling, acquiring the equivalent of an F1 team, that usually requires a mountain of capital.
Oh, yeah. It burns cash fast.
Right. A company can grow itself right into bankruptcy if it isn't careful. So I really want to dig into the balance sheet to see how they are funding this.
Growth without a solid capital foundation is just a liability waiting to explode. But the financials here, they show a company operating from a fortress position.
Okay, lay it out for us.
They ended the second quarter with $1.58 billion in cash and cash equivalents.
Wow.
Yeah, and for context, they entered this fiscal year with only $926 million.
So they're just piling up cash.
Exactly. The core business is throwing off so much cash that their reserves are swelling even while they scale up production. Total liquidity is sitting at $3.7 billion. And get this, they haven't touched a single cent of the revolving credit facility.
That's impressive.
Free cash flow alone hit $342 million for the quarter.
Okay, I have to play the skeptic here for a second, because while $342 million in free cash flow sounds fantastic, I'm looking at their liabilities.
Okay.
And there's a massive $2.0 billion line item for long-term debt, which is largely tied to that ZT Systems acquisition.
Right.
So when you are operating in a capital-intensive manufacturing environment, facing down a $2 billion debt load seems like a massive red flag.
Sure.
How is that not a severe risk to the thesis?
Well, the raw number of $2 billion sounds intimidating, I'll give you that, until you measure it against their earning power.
Okay.
In corporate finance, the health of debt is measured by the net leverage ratio. So basically, how many years of current earnings it would take to pay off the debt completely.
Right.
Right now, Sanmina's net leverage ratio is sitting at 0.56x.
Wait, really? So it would take them roughly half a year of their current earnings to cover the debt?
Yes, it's remarkably low. To put it in perspective, the company's own internal board target for leverage is between 1.0x and 2.0x. So they are highly under-leveraged relative to the cash they are generating.
That is wild.
And the most telling metric here is their return on invested capital, or ROIC, which currently stands at an incredible 34.7%.
Okay, break that ROIC number down for the listener. What does 34.7% actually mean in the context of a factory floor?
It means for every dollar Sanmina invests into their business, whether that's buying a new manufacturing robot, expanding a facility, or acquiring new engineering talent, They are generating nearly 35 cents in pure profit every single year.
That is an insane return.
It is. When a company achieves that level of capital efficiency, cash piles up incredibly fast.
Clearly.
And we can see exactly how confident management is in this cash generation by looking at what they're doing with their own stock.
Oh, the buybacks.
Yes.
In this quarter alone, they spent $160 million to repurchase 1.1 million shares.
Right.
And that completely exhausted their previous buyback program. But they didn't stop there.
Not at all.
The board of directors immediately authorized a brand new open-ended $600 million share repurchase program.
And, its $600 million authorization serves a very specific mechanical purpose in the market.
It creates a floor, right?
Exactly, an institutional demand backstop.
Yeah.
Because they are generating so much excess cash, the company itself becomes the most aggressive buyer of its own equity in the open market.
Wow.
They're constantly absorbing the available supply of shares, which mathematically increases the ownership stake of every remaining shareholder, puts a firm floor under the stock price.
And the broader market has definitely started to take notice of this math. I mean, following the earnings release, the stock didn't just tick up. It violently gapped up 12.5 to 14.5% in after-hours trading.
Huge move.
Blasting straight through the $215 level.
Technical analysts refer to that specific price action as a blue sky breakout.
I love that term. But for the listener who is focused on long-term wealth building rather than daily chart reading, what makes a blue sky breakout fundamentally important?
Well, a blue sky breakout means the stock has broken through every historical resistance level and is trading at an absolute all-time high.
Okay.
The psychology behind this is vital. In a normal stock that has gone up and down over the years, you have what's called overhead supply.
Right.
These are investors who bought at a high price, watched the stock crash, and are now desperately waiting for it to get back to the original purchase price just so they can sell and break even.
Gotcha.
That creates massive selling pressure.
Yeah.
But in a blue sky breakout, there is no overhead supply.
Because everyone is making money.
Exactly. Every single person who owns the stock is currently in profit. That drastically reduces the urge to sell, leaving the stock in uncharted territory, the blue sky.
Man, we are watching a real-time repricing event.
We really are.
The market is waking up and realizing they can no longer assign a low-margin electronics manufacturer multiple to this company. They have to start pricing in an AI infrastructure premium.
And the institutional sentiment reflects this shift completely.
Mm-hmm.
I mean, quantitative sentiment scores are tracking at a highly bullish 8 out of 10.
Wow, 8 out of 10.
Yeah, and we've seen major analyst actions. Argus raised its price target significantly even before the earnings dropped.
Right.
Firms like Susquehanna and JP Morgan are initiating coverage and pointing out a concept that is critical for long-term investors, and that is switching costs.
Oh, the idea that once a customer is using your product, it becomes financially or operationally painful to switch to a competitor.
Exactly. Think about the liquid cooling manifolds and the integrated power systems we just discussed.
Yeah.
Once a hyperscaler locks in Sanmina's custom architecture for a multi-billion-dollar data center build-out, the engineering becomes deeply embedded in their operations.
Right. They cannot simply fire Sanmina next year and hand the blueprints to a cheaper assembly plant.
No way. The physical integration is way too complex. Those high switching costs mean Sanmina is securing sticky, recurring, high-margin revenue for years to come.
But whenever we talk about a stock gapping up 14% overnight and hitting all-time highs, the immediate psychological hurdle for you as an investor is the feel of buying the top.
Of course.
Like, is it too late to get in? Are we just chasing momentum? Or is this the ground floor of a new valuation model?
It's a fair question.
So to answer that objectively, we have to look at the structural risks. We need to navigate the turbulence because the short-term reality for this company over the next few quarters actually looks quite challenging.
Yeah, despite the brilliant long-term thesis, any honest wealth-building strategy has to confront the bear case.
So what's the bear case here?
Right now, the glaring headwind for Sanmina is the global supply chain. Management was very transparent that they are facing severe material shortages, specifically in high-bandwidth memory and custom ASICs.
Wait, let's clarify that term real quick. What is an ASIC, and why is a shortage of them bottlenecking a company the size of Sanmina?
So ASIC stands for application-specific. Unlike a general-purpose processor, an ASIC is a chip custom designed for one hyper-specific task, like routing network traffic at light speed between thousands of GPUs in an AI cluster.
Oh, I see.
You can't just substitute an ASIC with a different chip. If you don't have it, the entire server rack just sits unfinished on the factory floor.
That's brutal.
And Sanmina's CFO explicitly stated that they had the capacity to ship significantly more product this quarter, but they were physically constrained by these component shortages, which they expect to persist well into 2027.
And those constraints have created a very strange dynamic in their forward guidance.
They have.
Because so many hyperscalers panicked and pulled their orders forward into the massive second quarter, the revenue guidance for the upcoming third quarter is actually a step down.
Right.
They are projecting $3.2 billion to $3.5 billion for Q3, which is lower than Q2 and below Wall Street's previous estimates.
Yeah, and if you just read the financial headlines, like Sanmina revenue stepping down, it sounds like the AI boom is stalling out.
Yeah, exactly.
It sounds alarming until you understand the mechanics of the supply chain. This is a sequencing issue, not a demand issue.
You know, it's like running the most popular exclusive restaurant in the city.
I like this.
Imagine you decide to host a massive record-breaking event on a Tuesday, right? And you serve your entire week's worth of inventory in a single night.
Okay.
So your Tuesday revenue is astronomical.
Huge.
But when you open the doors on Wednesday, the restaurant is empty.
Right.
The revenue dip on Wednesday isn't because people suddenly decided they hate your food. It's because you served everyone early, you were completely out of ingredients, and you were just standing in the kitchen waiting for the delivery truck to arrive with more supplies.
That is a perfect way to explain it.
The restaurant has a supply-constrained problem, not a demand-lacking problem.
Exactly. The hyperscalers are banging on the doors of the restaurant. The demand is ferocious.
Yeah.
Sanmina just has to wait for the memory and the custom ASICs to arrive on the loading dock so they can finish building the systems. Investors who look at the third quarter guidance and panic over a sequencing dip are entirely missing the larger structural story.
And the ultimate proof that management isn't worried about the Q3 dip is that they actually raised their full-year fiscal 2026 guidance overall.
They did it.
They are looking past the current supply chain bottleneck toward a massive target. They are projecting over $16 billion in revenue by fiscal 2027.
That $16 billion figure is the true north for this investment thesis.
It's massive.
And they aren't just pulling that number out of thin air either. There's a very specific operational catalyst anchoring that projection.
What's the catalyst?
September 2026 is their internal milestone for production readiness on next-generation accelerated compute platforms.
Okay.
Right now, hyperscalers are finalizing the designs for their future data centers. By September 2026, those new, incredibly complex architectures start rolling off Sanmina's lines in massive volume.
And when we talk about those future architectures, there is a massive speculative catalyst sitting right in front of them. We noted earlier that the $1.88 billion from ZT Systems was driven entirely by AMD platforms.
Right.
Sanmina's CEO has publicly noted that currently they have zero integration with NVIDIA-based platforms.
Zero. And in the AI hardware space, zero exposure to NVIDIA is usually a death knell.
Usually.
But for a company that has already proven it can engineer liquid-cooled integrated racks at a massive scale for AMD, that lack of NVIDIA exposure represents an enormous white space for future growth.
Oh, absolutely.
If Sanmina's engineering and manufacturing capabilities are robust enough to handle the most advanced AMD rollouts, it is highly logical that they will eventually capture future NVIDIA platform designs.
And if they crack the NVIDIA ecosystem and start integrating their hardware, that $16 billion target for 2027 starts to look highly conservative.
Very conservative.
And taking an even wider macroeconomic view, we really have to look at how the massive tech conglomerates are behaving. The cloud providers, the Amazons, the Microsofts, the Googles, they are treating AI infrastructure as a competitive necessity.
It is.
It is an existential arms race, and they are spending tens of billions of dollars on capital expenditures to win it.
Tens of billions.
In a world where controlling the physical hardware pipeline is a matter of survival, a vertically integrated infrastructure company like Sanmina becomes an incredibly strategic asset.
Yeah, without a doubt.
I mean, it is not unreasonable to imagine a scenario where one of these massive cloud players simply decides to acquire Sanmina outright to completely own their hardware deployment and lock their competitors out of the supply chain.
The structural insulation here is profound. Even if the broader consumer economy slows down or if software sales dip, the major tech companies cannot afford to pause their AI data center build-outs.
They just can't.
The macro tailwinds of AI capital expenditure provide a massive buffer for Sanmina against broader economic uncertainties. They are manufacturing the heavy artillery for a war that the biggest companies in the world cannot afford to lose.
Well, we have covered a massive amount of ground today, moving from low-margin circuit board assembly to the complex thermodynamics of liquid-cooled AI server racks. Let's distill all of this down into a final, actionable takeaway for you as you build your long-term portfolio.
The overarching thesis here is an 8 out of 10 bullish rating, and this is firmly a multi-year hold.
Okay.
You have to look past the legacy reputation of the company. The true wealth-building inflection point is the 2027 target of $16 billion in revenue, which will be unlocked by the September 2026 production milestones.
Right.
For the investor who understands the mechanics of the supply chain and can stomach the short-term noise of component constraints and sequencing dips, this is an opportunity to ride a massive hyperscale integration wave.
Yeah.
The market is still in the middle of repricing this company from a traditional manufacturer to an irreplaceable pillar of AI infrastructure.
It really forces you to reconsider how you view the AI boom as a whole, and I want to leave you with a final thought to ponder today. The financial media, the venture capitalists, the broader markets, everyone is entirely fixated on the brilliant minds writing the AI software and the companies designing the silicon architecture.
True.
But code does not exist in a vacuum. The ceiling of artificial intelligence will not be dictated by software. It will be dictated by the physical limits of the real world.
Absolutely.
It will be constrained by the availability of copper, the routing of massive electrical currents, and the ability to prevent data centers from literally burning themselves down.
Yeah, the heavy metal.
Exactly. As this revolution accelerates, consider what happens to the global balance of tech power when the heavy metal companies building, cooling, and powering the hardware become just as critical and ultimately just as valuable as the companies writing the code.
It represents a total shift in the center of gravity for the technology sector.
It truly does. Thank you for joining us for this analysis. Remember, the future is built on fundamentals, not just hype. Have a great day, and keep looking for the signal in the noise.